Alrighty, folks, you may not know this if you're relatively new to the channel, but this young man right here, he and I used to talk 2 or 3 times a week. He has created the most content on my channel of
Yeah,
any guest, and I appreciate him for that, Mr. Lumberjack
awesome.
Landlord. How you doing?
I'm doing great. It's always a pleasure. It was fun. It was like we weren't even working. We're just like recording our hanging out. So yeah, I get it. It was great.
It was great.
And that,
Hey,
and
what
now
is
and now we're so busy.
exactly? We definitely got more busy. You took on a lot of projects.
Oh,
I've cut my work schedule from 7 days a week to five, so
yeah.
it's pretty cool. But you and I were a part of a call, I don't know, a couple weeks ago, and somebody asked a question, and I think people were shocked by our answer. So I thought we should go a little bit deeper. So you and I combined have over 40 years of experience with real estate investing, own over 300 units, done hundreds of transactions, and we were asked, matter of factly, have you ever done a sub two deal? And I came out right away and said no. You thought about it for 10 seconds and also said no. I think people were shocked by that. What I
Mhm.
don't think they understand is our 20-year plus track record involved most of the time where you wouldn't want a sub two deal, at least certainly not like today. So why don't you talk about your experience and why you have as of yet never done a sub two deal?
Yeah, I mean, I think that in the sub two position, I think that largely the reason that somebody would want to acquire somebody else's debt is and the asset, the debt on the asset is because it's at a better rate than what they can get. And pretty consistently, like during the crisis, we were better off buying it from the bank because you and I both know when it went to foreclosure, we weren't getting cheap debt. We were getting $100,000 price reduction or 150,000. We were buying stuff for less than land value.
Mhm.
And so
Yeah.
it really comes down to what is it's not so much the asset as much as it is what debt is owed on the asset, and then what is the rate of that debt. And this is where it's really kind of the first time in the last 20 years
Mhm.
where your debt, that where you have access to debt that's 3 points or 4 points less than market, the asset has increased in value as well.
Mhm.
And so this is the first time like that in the 20 years that I've been investing where it's not a point of margin. It's
Right.
3 points, 4 points. I mean, you have people where you're able to acquire assets at 2.5, and if you
Right.
were buying that asset, it'd be 7.5. That's a 5 point spread.
Yeah.
That's massive.
Yeah.
That's why.
I think there's a couple of things. So I think sub two, and Pace Morby is obviously the guy known for
He's
all
the
of
man.
this, his
Yep.
sub two community.
Yep.
He's been acquiring sub two deals for, I don't know, a decade or so. So
Yeah.
clearly it is possible in
Oh,
all
sure.
markets. But until recently, for me, learning a new vehicle, the juice wasn't worth the squeeze.
Sure.
Um, I was on. He has a show. I almost want to call it Hotel Hotline, but that's not it.
Sunday
Something
service.
Sunday Service. Yeah. So I was on Sunday Service about 18 months ago,
I remember.
and I shared with him and Cody that I thought Sub Two was coming into its prime.
Agreed.
Not since 1982 has Sub Two been the right answer to
Right.
solve a real problem. And obviously, Pace Morby is friends with Robert Allen, the original creative finance guy who grew up in the '80s. So again, I think the Sub Two community, I think investing and learning how to do it right
Mhm.
is a skill that many people should look at. I have admitted many times I need to do that.
Mhm.
But again, if you're going to ask me why I didn't do a Sub Two deal in 2011, I didn't want the debt. That's the short answer. Is I didn't want their crazy 11% interest, and oh, by the way, I was going to get a 100K price cut. So, um, yeah, I mean, it's just wasn't the right answer, and I had other opportunities, I guess.
Well, I think the other thing too that's much bigger now is seller financing.
Right.
Right. And so it's something where you can get great debt. It's just seller finance debt. So what's really come about in the last 10 years was, did they ever do seller finance deals 10 years ago? Of course they did. But what was the volume of them?
Right.
Everything now is 10x, 15x, 20x, 100x. Like, in 08 to 2012, was anybody doing a sub 2 deal? No, they were buying it from the bank in foreclosure, drastically reduced, because those rates, even if you were getting one that was going bad, it was still 6.5 or 7, and rates were, you could get in the 5s or 5.5. Right. And on top of that, you're getting a massive discount to take the asset, right? How many conversations did we have with banks where they were asset managers, right? Asset managers that are saying, hey, I've got a book of houses, right, and this is what I want to do with them. So it's just like anything else, it's necessity is the mother of invention. And so there's smart guys like Pace and that do aggressive things like that. Mm-hmm. For me, I know that in the last 10 years, there's only been 10 or 12 sub 2 deals that he knows of where the due on clause was done, or they kind of went sour.
Due on
sale. Yep. The due on sale clause. And so I think that for him, I think that there's a lot of people that have this level of safety about them and feeling that. I think the challenge that I have, right, is that to me, that's a little bit of whistling past the graveyard. That's not saying that his strategy is bad. I think Pace is awesome, and he's worth 1,000-fold what I am.
Oh yeah, he's right? Worth 10x what you and I are combined, I'm sure.
Probably a lot more than that, but it's just because it's ridiculous.
Yeah, he's doing great work.
But that being said, the risk as a risk assessor, right? You and I are really good at assessing risk.
Downside. I think about the downside. I want to be clear. For 20 years, I've been the guy calculating downside, protecting the downside, and then upside takes care of itself. That's correct. All I do.
Right. And we're willing to be a little bit more range bound, like not get those crazy insano stuff, but we're staying range bound where we still can get really good, but we have much more limited downside. And so here's something that I hope doesn't happen, but I see could happen.
Sure.
As we go into mortgage crisis, as we go into an adjusting market, as we go into a recession, right? And this now has the attention of a lot more people. This isn't something that's under the radar anymore. Now everybody talks about it. The simple thing is if banks want to get out of this really inexpensive debt that they have on an asset, it's one letter from an attorney. It's one letter, and they can pursue it and they can break it. So if you still in that mortgage, it's not assignable, and you have a due on sale clause, well, then kind of, sort of, it hasn't happened yet, but the banks aren't in this, every single day they're on the front page news of how they're collapsing, right?
Right.
If we get to that, that's what I think changes in the market, is that the banks start looking at ways of how much is their mortgage profit down on deals now, right? They're doing 40% the number of deals. So their profits are going to be way down because they're doing far fewer deals. And for them, it's a machine. It's how many deals can I get through the door because I'm going to make my amount of profit that I need on every door. So for them, it's volume based. It's quantity. It's not quality. And so the challenge that I think is going to happen is that I think that market starts to could potentially get fractured, potentially. And that some banks that might be in a little bit of trouble look at getting due on sale clauses done.
Yeah, when I look at sub 2 or sub 2 specifically, again, I think we're coming into an era where if you invest the time to do it right, and again, I got to tell you, I don't know what doing it right is today. I haven't done the research. I haven't done the work, right? What am I wearing? The hat? I haven't done the work, right?
Yeah.
But I understand it, and I do think it's the right answer. I think sub 2 at least has a 2-year run where it's going to be amazing and thus worth the effort. But for 20 years, and the reason I answered the question like I did so quickly, never done one, it just wasn't worth figuring it out, right? What happens if the seller goes bankrupt? I mean, there's lots of what ifs that I have no idea about. And I'm sure Pace talks about them all the time. I have not invested the time figuring them out. But I thought you and I should adjust, or at least have the conversation. Guys who have, all of what we have, 40 years experience, why we haven't done one. If we were starting today,
heck yeah.
If I was starting today, I would definitely figure it out.
Yep. Pace and Cody and Christian multifamily strategy. Right?
Yeah,
I'd be diving deep into that and be like, yep, this is something we're going to do. But that's the other thing too, Mike. We're both on a stage in our investing career where we probably aren't going to add a whole lot. It's going to be very niche.
I'm going to be sitting this is exactly how I envision it. You and I are in the batter's box, right? Yeah. So we are able to swing if we want to.
Anytime.
Oh, down the middle. Oh, down the middle. Oh, you put it on the tee? Oh, I'll hit that one.
Yeah, like, right, like you get, as you get further on in your career, you look for bigger returns, not overall dollars, but percentages. But you create better margin, you create better returns. And so you get to a certain point as an investor where it's like, if I just optimize, I've spent 3 years acquiring, stabilizing, and optimizing.
What do you think? You got another year left?
I probably have yeah, about that. Probably about another year left of optimization. And then at that point, last year I gave myself a $250,000 raise just based on rental increases.
There you
So
go.
it was about, it was about $20,000 a month, a little over 20 grand a month. And that was just rental increases across the portfolio.
Yeah.
And that wasn't with just raising people's rents. That was them leaving, rehabbing the unit, bringing up a couple classes, and then saying, now I can go to market with this asset.
Right.
So for me, it's like, do I need to go out there and buy another 10 duplexes? No, not really.
That's exactly where I'm at. I look to, again, to me, it's like, if it's on the tee, I'll take a swing. That's kind of where I'm at. Right. So, it's pretty cool.
If it fits everything that I do. Right. And so the one crazy project that we've teased, like that just is that just completely melted my brain. I was like, if I'm going to do it, like I couldn't have done that project 10 years ago. It's going to be very capitally intensive. And so we're not sharing it with anybody yet, but we should be closed in a few weeks if these people can get their act together. But that project is going to take all of my brain power, all of my effort, all of my energy, all my time. So
will that be the one that makes you go full time? Will you quit your day job?
Yeah, probably. I mean, we can do it now. It's just the big thing for us was stable, the acquisition, which we did a ton of in 20 and 21, a little bit, and a decent amount in the beginning half of 22. And then since like the middle of 22, we've done maybe 4 or 5 deals, but nothing crazy. Right. Before we were averaging, so in the last, 14 months, I think we've done 4 or 5 deals. In the previous 18 months, we did 19 deals. So we're doing one a month.
Yeah.
And they were all value. None of them were turnkey.
Value.
So we're getting through the stabilization phase. Now we're hitting optimization on a lot of them. We're hitting stabilization on a number, but to get the stable to the optimized, we're going to, over the course of the next year, when we move stuff from stabilization to optimization, which is the fine tuning of the asset itself, but then also that final rent bump, that'll be probably another, I don't know, $150,000 to $200,000 in revenue. And then at that point, the portfolio is largely optimized. Right. And then it goes into kind of service mode, and I make Dion look like a hard worker.
I think that's a good story. Keep telling yourself that.
So that's kind of the plan anyway.
Yeah. Matt, how can people find you?
Lumberjack Landlord on YouTube and Instagram. We're doing a ton of these kind of rotations in housing. And so we're showing a lot of these projects and the little things that we're doing, like what I teach in my course, kind of how to skill up and get elite. But Lumberjack Landlord, 11:30 a.m. Eastern time on Sundays, live stream, and ask your questions and I'll answer them.
Awesome, buddy. Thank you so much.
Thanks, Mike.